Think of the enhanced ETFs as core building blocks for equity allocations, combining the steadiness of broad market exposure with the insights of active management, and doing it all efficiently and at a low cost. These ETFs don't just track an index, they're built with a clear view of the benchmark characteristics and risk, but use proprietary return drivers, what we refer to as factors, to objectively evaluate securities, building a portfolio with stronger return opportunities. Owning an index, you must take the bad with the good. Our approach we view as more selective, a more thoughtful alternative to index investing.
Our quantitative research helps us make informed, data-driven decisions about every stock in our investable universe. We evaluate a company's valuation, growth prospects, quality, and other unique characteristics. That drives a systematic process that objectively decides when it makes sense to take a different path from the benchmark, and by how much, within our disciplined guidelines. We are aiming to add alpha while keeping the overall fund profile comfortably familiar with the benchmark.
We believe data and technology are essential to every part of modern investing. With a quantitative approach, we're able to evaluate thousands of companies and compare them daily. Applying computational power that can systematically uncover insights on companies and make investment decisions with respect to a well-defined risk management framework, that's key to delivering on these strategies' objectives.
What I love about this approach is that it helps remove the emotional biases that often get in the way of good investing. Instead, we rely on objectivity and discipline, and that's what drives consistent outcomes for our investors.
This is not something that can be created overnight. One of the things that's often overlooked in quantitative investing is just how much goes on behind the scenes. It's more than just a few smart signals or models. You need access to clean, reliable data from a wide range of sources, and the systems in place to manage, update, and validate those inputs. Without that foundation, even the most sophisticated investment ideas can break down.
Fidelity has the resources to invest in that technology stack and teams dedicated to data governance, research tools, and operational support. That means as investors, we can spend more time on research and portfolio construction and less time chasing down data issues or coming up against system limitations. Quantitative research is really the engine behind everything we do. It's not just a one-time thing. It's an ongoing process that's constantly evolving. A common criticism of quant investing isn't the data available to everyone? I would argue that access doesn't equal advantage. What really sets managers apart is how they use the data.
We don't just take prepackaged signals from third-party vendors and plug them in. Instead, we acquire the raw data and then apply our own research, our own insights, and our own experience to build proprietary signals that we believe are stronger, more relevant, and more transparent. This approach gives us more control over what goes into our models, and just as important, a much deeper understanding of why those signals work.
Take something like one of our components of our growth signal that measures the sustainability of growth through patent filing information. We could simply use the top-line data showing the number of patent filings, but we dig deeper, utilizing the raw data that helps us uncover potentially how valuable a company's patent portfolio is and the pace of innovation. We can view this over multiple look-back periods and compare versus peers, as well as a company's own history. At the end of the day, we believe the edge isn't the data, it's in how you use it.
Risk management is absolutely central to how we invest. We put it on an equal footing with the alpha generation. It's built across multiple layers. We use a custom risk model that's specifically designed for the investment universe we're managing. It's based on our own alpha signals and how we build portfolios versus off-the-shelf third-party models that might not fully capture our process.
On top of that, we apply a set of core constraints to help promote diversification and maintain alignment with key benchmark characteristics, things like sector exposures, country weights, and style tilts. These act as additional guardrails to keep the portfolio from deviating too far from the benchmark. And finally, we have an experienced investment team providing oversight every step of the way. This isn't a set it and forget it black box. We are at our desks watching the data, questioning anomalies, and at the ready to manage risk when we believe our process may not be positioned to react to a risk unfolding quickly in the market.